This is News You Can Use.
Welcome to News You Can Use for the week of July 25th. Over the past 6 weeks, we've shared insights with you, updates from Doug Duncan, the chief economist for Fannie Mae. He offered his perspective regarding the state of housing and his best forecast for where we're headed in the coming months and years. Without a doubt, the market has shifted. We all know that. In 2020 and 2021, we all experienced a record hot housing market with prices soaring in double digits. Coupled with record low interest rates, home buyers lucky enough to win their contracts were largely able to absorb those price increases. Well, times are changing. The headline for 2022, without a doubt this year, economic headline will be inflation. Over the previous 2 years, the U.S. government and Federal Reserve went to battle against the unseen enemy of COVID-19. And they did so by pumping trillions, that is trillions of dollars into the U.S. economy. Coupled with a decrease in oil supply and really supply of almost everything. And then on top of all of it, Russia invades Ukraine. Our economy entered 2022 running really hot with inflation numbers at 9.1%, a 50-year high. This inflation, which we've all felt anytime we buy anything, has far exceeded the goal for the Federal Reserve of 2% inflation. We're at 9, the goal is at 2. Obviously, something needed to change. The U.S. Federal Reserve, they didn't just sit by idly. They've gotten involved now. Instead, the Fed they are now waging an intense fight against rising prices, against inflation. And they're using interest rates, which is their primary weapon to win the fight. A side effect of raising interest rates, the Fed, though, is that mortgage rates have gone higher as well, which directly impacts home affordability. As a result, many buyers have pressed pause on their home searches. Why? Well, they can afford less home now because of rising rates, and they also want to make sure that the homes that they're buying are priced correctly. We've had amazing price increases in the last couple of years, so those two things in combination are creating a bit of a pause. Although the increase in the Fed funds rate, the Federal Reserve's rate, has coincided with an increase so far in mortgage interest rates, it's important to note that the federal funds rate is not directly correlated to home mortgage rates. The federal funds rate is the rate that banks charge each other. The Fed charges banks and banks charge each other for overnight loans. So it's a very short-term rate that the Fed controls. When the Fed raises the federal funds rate, interest rates do go up across the economy. Adjustable rate mortgages go higher. Credit cards go higher, home equity lines of credit, and also other types of loans. Some of these are tied to prime rate, which is based on the federal funds rate. So a rising federal funds rate can affect all interest rates, and it also has an effect on the 10-year Treasury bond, which most directly correlates to mortgage interest rates. Let me just make sure you're clear. Not always does the federal funds rate affect long-term rates by if the Fed funds rate goes higher, then mortgage rates goes higher. And we're entering one of those periods. It's an important distinction to keep in mind this coming week as we look for the Fed to once again raise the federal funds rate in its effort to combat inflation. We're expecting they're going to go higher by 75 basis points or maybe even 100 basis points. By the way, that will be the second largest increase we've had in 40 years by the Federal Reserve. They'll announce this increase, by the way, this Wednesday, July 27th. Here's the good news. Although not as quickly as any of us would prefer it, it appears that the Fed's effort is starting to work. While mortgage rates have spiked, they've gone up higher, faster than they ever have it in history. From February to May, we went from 3.5% to 6%. But I fully expect now that the Fed is fighting inflation that interest rates will stabilize at 6 or possibly in the mid-5s and even lower by the time we get to the end of the year. That's what our thinking is right now. Once inflation is actually tempered and tampered down some, the Fed will then be able to slowly lower interest rates to make sure that they continue to keep the economy moving forward. Here's our long-term perspective. Although we've all enjoyed a booming housing market for 20 and 21, it's been decidedly a seller's market. Many buyers have been frustrated by the lack of homes for sale and the overwhelming competition to buy a home and get it under contract. The Fed's recent and future moves will bring some much needed relief. While home prices are not expected to drop materially, they are anticipating to somewhat stabilize, and I do expect we will see some sellers negotiating finally with buyers. That too may bring some relief to buyers who've been struggling to stay ahead of price increases, not just in housing, but in housing as well. And couple that with higher rates, you've got a pause. In short, opportunity still abounds as it appears that some normalcy will return. And keep in mind, our employment numbers are 3.6%. So we're in one of the most favorable employment markets we've ever had. So I do expect we're just in a pause. And as we finish 2022, the Fed's current activities, which are creating a bit of a pause in the long run, is actually some good news that we can all use.